It's now David Giroux, portfolio manager at T. Rowe Price's Capital Appreciation Fund. David, thanks for joining us. Good to see you. Based on your notes, it seems like you're finding it hard to find many things you're confident will appreciate going forward.
No, I think that's fair. It's funny, you know. I think about the last 15 months and being on your show 4 or 5 times. You know, there's always been an area where there's really good value, right? In March it was cyclicals, and in June of last year it was COVID losers, and in kind of October it was banks. Last time, kind of carp stocks and utilities looked really attractive, and even those have kind of run 15 to 20%. So it's like the first time. There's not any place where I can say there's really great absolute value in the marketplace. Really, for the first time in the last 15 months, that's a little bit different. Now, there's still relative value, right? But not really great absolute value like in the past.
So does that?
There's still relative. Oh, go ahead.
Well, I was just going to say, does that mean you're much more defensively positioned or much higher cash values than normal?
Yeah, actually, it's funny. It's the first time in the last 15 months where we're actually underweight equities. We really did that. We went overweight equities March 10th of last year. We've been overweight equities almost all through the last since that time. It's really just in the last 2 or 3 weeks we've kind of gone 100, 200 bips underweight equities. So we're having trouble finding good things that we feel good about on a next 5-year basis today.
It's interesting to hear you say it, David, because we have value fund managers on all the time here, and they reiterate their case for value, say this is their time, which we've seen in the market. This is their year. And part of the defense, even with the run-up, as, well, we've underperformed for the last 10-plus years. So there really is still room. You don't feel that way?
Well, remember, value is underperformed for 2 reasons. One, value is not kept up from an earnings perspective with growth. About half the value universe is kind of secularly challenged, right? So multiples have compressed, earnings growth have depressed. I think when we talk about value versus growth, I think it's kind of an artificial constraint. I kind of think about value kind of being companies that are not facing secular challenges, like regional banks, industrial companies, utilities, and then you might think about the secularly challenged companies. So there is good value probably, on a relative basis, still in parts of that value universe, whether it be utilities, regional banks, select industrials. But there's not great, I think it's a little bit hard to make the case for the value that looks really attractive. Again, a lot of the traditional value sectors, whether it be retail, banks, have all had really nice runs over the last 9 months and trading much higher valuations than they have in the recent past.
Shepard Smith here. Thanks for watching CNBC on YouTube.